Hi, this is James Eng with Full Capital, and I got Wes Rock with Marcus Melchap with me today to talk about a new deal. Wes, how's it going, man?
It is great. Just got back from Vancouver. I wish I was still up there with the cooler weather, but love Texas.
It's only 105 right now, so you're inside enjoying some
Yeah,
AC. We
exactly. I'm cool.
All right, man. So we can get into this deal, but maybe before, just give people a little bit of your background, and then what you're seeing in the market in today right now.
Yeah. I've been with the Flow and Hoover team about 4 years now, and Marcus Millichap same time. I specialize in the 80s to 90s space, 170 units to about 400 units. That's my lane that I stay in. Our team does expand to Oklahoma, New Mexico, Arkansas, Louisiana, and then we come around about San Antonio. So from a team level perspective, we focus on private clients and we cover probably the most ground in the nation from a team level. But then, of course, we have our IPA division who handles institutional properties. We also have a 75 and under division as well. So a lot of opportunity to grow if you're looking to scale up. If you're looking for a different product type, we have that as well.
All right. So obviously the market's been a little choppier the past
Yeah.
12, 18 months. So what are you seeing right now, just sort of on the ground, talking with owners? What's sort of the sentiment right now?
So I would say a lot of owners are trying to figure out their situation. And what that means can look different for every owner. That could be, how do we get dry powder? How do we get out of the deal we're in? And then realize that maybe you didn't hit a home run, but you're not losing money. So let's go be a buyer in this market than rather trying to operate through it. Others are don't have that luxury and they have to operate through this. That's either doing cash and refis, that's doing some preferred equity on top. Um, Worst case is just getting out of the deal and losing your equity you have. And so that's not everybody. But I will say a majority of the operators we're talking to are trying to figure a way out. I have between 12 and 15 deals right now that we are constantly updating our BOVs on monthly. Once the T12 comes in, we update the underwriting and we have certain metrics that we're trying to hit. Just as a general, stance is from say if it's an agency deal, does it meet a 5.5 tax adjusted cap rate going in? What's the cash on cash return? Cash on cash is really significant these days because one of the conversations that people are having is why multifamily, which is risky compared to a T-bill, where no risk, and I can get that for 2 years and I sleep well at night. And so, obviously, the tax advantages, the appreciation, the equity multiple are there in multifamily that are not in the T-bill, but you still have to combat that as a general partner and raising money with limited partners.
Right. Okay. All right. Perfect. Well, let's get into this deal. So 288 units in Arlington.
Yeah.
I pulled up a map here. Maybe give a little bit about the location and what you like about this sort of general area.
So Arlington epicenter with entertainment here in DFW. You have the Cowboy Stadium, Ranger Stadium, Globe Life Field, Texas Live, Six Flags. From an entertainment standpoint, it's you couldn't ask for a better place to be located or a better city. It's between Fort Worth, it's between Dallas. So if you do have to commute, you can go right down 30. If you work at the airport, it's just north of you. So from an entertainment perspective and employment perspective, perfectly located. North Arlington also has just had, better, it's a better pocket of Arlington. You get more towards 30. It's a little bit older, maybe a little bit more affordable product. But North Arlington historically has done very well. And it's just one of those pockets that have been coveted by the likes of an S2, a Madeira, Night Vest. All of those guys have invested here in the past and they've done well.
So, did you launch this deal because the Cowboys are starting their season right now? So,
Hey, other income and parking, man. You know it.
all
Reserve
right.
parking.
Yeah, so let's pull up some pictures. So this is a 1980s deal. Uh,
Yes.
what has the seller or maybe some of the previous owners done here on the exterior? It looks pretty clean. Looks some updated balconies. Pretty nice pool. Maybe talk to just the overall property on the exterior side.
So that's one of the nice things about this deal is they've spent about 2.5 million in capex, with the majority of it on the exterior. The pool does look just as nice in person as it does in the pictures. The paint looks great. It's actually one of the points on the tour that I stop and just kind of look at the roofs, look at the common areas. It's you could tell that Western Wealth, who's the owner, has taken a lot of pride in taking care of the asset. So in times like these where you know equity is hard to come by, the last thing you want to do is go put it in siding, go put it in paint or repair a roof. So all the money you're spending here is going to be on the interiors and improving operations. But from an outside standpoint, it tours very well and it's very clean. They've done a great job with that.
Okay, so not much on the exterior to do.
Yeah.
I pulled up some pictures on the interior. Maybe talk to in terms of upgrades. What have they done on the interior for this property?
So I believe I sent you the video for like the virtual tour I did. So that'll compare and contrast the two styles of units for people to look at if they want to. But what you're looking at right now is a partial or an upgraded unit on the rent roll. And the biggest difference is the gray scheme, subway style backsplash, shaker fronts. You do have a lighting package that's in the upgraded units. And then most of the units have vinyl plank flooring that are classic. So if you wanted to update it, you could, but you don't have to. It's more of making it feel light and bright and airy. And on the classic units, they still have that, tan undertone, brown cabinets. Um, they look nice, but they're just a little dated. And so what's great is whenever, the manager's touring, every tenant gravitates towards these units.
Right, and so they've done. You said about a third of the units.
94.
94.
Yep.
Okay.
So just
All right.
just about a third. Yeah.
All right. So so we looked at the exterior. So on this side, so 1980s. So it sort of has your
Yeah.
standard washer dryer connections in all the units, which is
Yep.
nice. And then I'm trying to see. All right. So is it individual water heaters or is it
It
boiler?
is. It is.
So individual
So
water heaters, individual HVAC. All right. And
yep.
then so the
And
2.4
that's I think
million. Yeah, good.
And I think that's a nice point to sit on because as your properties grow and your tenant base changes over time, that this property will be able to grow with the times. Because if you look at why when tenants make more money, they want more amenities. They want a place that's nicer to live. And when you have these kind of amenities like inside full size washer dryer, people want to do their own laundry. They don't want to go to a laundromat. People who make more money don't want to live in a property that has a boiler. They want to see their hot water heater. You know, that kind of stuff is what makes one 80s property different than another 80s property.
Right. Okay. So majority it looks like majority of the money went exteriors, amenities, and then mostly interiors though.
Yeah.
Here on the capex. So the new buyer, sort of what is the opportunity for them to come in? And sort of what pop do you think you can get in value from that?
So a good portion of this is going to be operational. There's a significant amount of loss to lease here, bad debt, concessions that operating it with a higher, what I would say, a higher collection percentage, you're going to be able to take advantage of through the first year. But what's nice is that every single unit can be updated. Obviously, we're not updating it with granite quartz or anything that would cost a 10 to 12,000 to fit to upgrade. We're just saying bring up all the classics to the standard gray finish, shaker fronts, tile backsplash. Do that in these units. And the $7,500 should be a healthy budget for people to do those items. The other item that we have in here that you'll see on the bottom line is adding washer and dryers to every unit. So that way your rent is just consistent. There's no deviation. Regardless, of whoever you're leasing a unit to, they have a washer and dryer. So that will hopefully attract a better tenant as well, that those amenities are already at the property. And that's why there's $0 for value creation there.
Okay, but yeah, you're just bringing everybody to the standard level that you're
Yeah.
every unit's already come in with washer dryer. It's a little probably easier to lease from that point of view.
Oh yeah,
and then really focus in on just upgrading the remaining classic units to sort of what we saw in that picture beforehand. Um,
exactly. And I
okay,
think, one thing is you don't even have to buy the washers and dryers. Those are one of those items that somebody can, sign up with a program where it's like a revenue care and they supply them.
okay, all right, nice. So what are sort of in place rents at Brookside now, and how does that compare to the comps?
Yeah. So let me pull up my sheet real quick.
Yeah, no problem.
So in-place rents are about a buck 62.
Okay. So
And one thing to
1,300. Okay.
Yeah, 1,300. And
Okay.
so one of the things that, when looking at this is the current owner has an LRO on the property, so lease rent optimization tool. And so, that sets their rents. But when you compare what we have in the pro forma to, the properties around it, especially with the washer and dryers, we're 100% spot on. It stacks up very nicely, whether it's, Rise, North Arlington, Heather Ridge, Case. You even have the Jackson. That is another deal that CAF owns and operates. So those two, all those properties, you'll be able to use as good rent comps for this asset.
Okay. All right. So here's sort of the unit mix. So it looks like it's about half and half, ones and twos, and then you're seeing about 150 in premium from where it is
Yeah.
to once you do the upgrades.
Correct. And you're going to see, one thing is when you're looking at the rent roll, some of it might not look like that exactly. And that's just because of the lease rent optimization that they're using. But when you go through the leases and you go through, classics versus partials, you'll see the difference.
Okay. And what they're getting. Okay. So
Yeah.
does that lease LRO you were talking about, do they have it broken out on the rent roll upgraded versus non, right?
Yes,
Yeah.
they do.
Okay. All right. All right. So here's the historical sort of financials and then sort of where you think sort of year one should be at. What's some of the big changes sort of between actuals and year one?
So the actuals, and I like, one of the things that's nice here is that when you're looking at the expenses from a pro forma perspective, they put a lot of stuff above the line, and I know you're going to talk about that later when it comes to adjusting for that. But as you can see from an income standpoint, all the economic vacancy there is. There's a good amount of loss to lease, and part of that is because of this optimization tool, where it forecasts 2 months out where vacancy is going to be. So if you can stabilize your rents on a month to month, you're going to be able to capture a significant chunk of loss to lease. The other part of this is concessions. They've dealt with a little bit of fraud here on the property, a little bit of what I would say people that are being sneaky, like what happened to the Camden guy,
Hmm.
where his identity was being used.
All right.
So no one's immune to that. But they've implemented programs called Snapped, Lease Lock that are really going to help with that vacancy credit loss.
Okay. So just like cleaning up maybe the screening for the tenants and then
Yep.
collections, focusing on collections. And then so on the expense side, you're really focused on bringing it really just to market expenses here in terms of admin, advertising, payroll, things like that,
Yep.
compared to historical. Okay. Let's see. All right. And then so after that year one pro forma, how did you guys forecast sort of after that in terms of year two, three, four?
So we're growing rents by 3%. Not significant. We realize that we're in a market that is extremely challenging for, for renters, tenant, you name it. It's not, gone are the days of 18% rent growth.
Right.
So we're growing rents at, hope what Powell says inflation rate, 2 to 3%. But we're also giving 3 years for that business plan to be implemented as well. So really at the end of year three, which coincides with the debt that we're proposing to be put on this, is when you're going to reach the highest level of income. After year three, it will table off into just, lease trade outs and whatever the market's dictating at that time. But if you're implementing all of our value creation and optimizing the property through operations, we feel like it is extremely achievable to hit that income years 4 and 5.
All right. And then do you guys, what's the whisper price on this deal again?
So 125 a unit, 36 million, free and
36
clear.
billion. Okay, so 125 a door, sort of 1980s, North Arlington. Seems like a pretty good basis in terms of overall pricing. Majority of people that we've seen just in the last 6 to 9 months have really been focused in on Fannie and Freddie just because
Yeah,
they've been pretty clear in terms of execution. So I mean, right now we're sizing just sort of with the in-place income and market expenses, we're getting to about 18.5 at around 6 and a quarter. And then the other option on this one, I mean, we've seen some operators take bridge where like on this particular deal, you can get a little bit higher leverage. You're probably north of 25 million with the rehab budget in there. I think we put maybe 7,500 a door or 10,000 a door here. And then you have your initial fund at about 65%, and then buying a lower strike. So SOFR is about 5% right now, 5.5, but buying a lower strike and just sort of setting up almost like setting up a fixed rate for yourself for the first 3 years on that
exactly.
deal.
Be very aggressive with that interest rate by buying a good rate cap.
Yeah, so that'll give you flexibility. So here's some of the underwriting just in terms of where the deal sits today and based on in-place income and sort of market expenses. This is the NOI that we're getting to, which is sort of right in between sort of the historicals and then sort of that pro forma year one. So Fannie is going to look at it more on this way,
Yeah.
and then the bridge lender is definitely going to be asking for your pro forma going out, and they want to see what you're going to be able to hit sort of by year 3 out there.
Yeah.
So this deal has been on the market for a couple weeks, and you
Yes.
guys picked the call for offers date yet?
Yes. So September 7th, right after Labor Day. So we have about 2 weeks from when we're recording this to get out there tour. I will say it's one of those properties that, yes, it's 110 degrees, but if you're looking for an opportunity where last year, 18 months ago, same exact deals were trading for 160, 170 a unit. And you can operate through some of these challenges, it's an amazing deal. Personally, I love the unit mix. It's 50% ones and twos. We talked about the mechanicals. It has, the bark park, the pool, playground. It's just a great 1980s workforce housing deal, which is traditionally done very well. So you don't have to, make sure all the stars align to do well here. It's a lot of blocking and tackling. So let me know if you want a tour. My, phone number, emails there. If the date works, shoot me over an time and we'll get you out there.
All right, Wes, thanks for coming on, sharing your insight on what's going on in today's market and sharing about this deal. And definitely set up some time to go out and tour this property and make an offer if you think it fits your criteria. And Wes, I appreciate you coming on. And
Likewise.
we'll stay cool, man. Stay cool.
I try
All
until
right.
October.
All right. Sounds good. I'll see you.
Thanks, James.
All right.